We're here with Rolf Agather from FTSE Russell to talk about smart beta investing. Rolf, can you just give us an overview of how you have seen smart beta investing evolve over time?
Yes, and actually, we every year have taken a survey of large institutions around the world for the last 3 years, and it's definitely been growing at quite a rapid pace. So, smart beta's been around for 10 years. And we've seen it move and evolve from fundamental weighting, which was really the early versions of smart beta, all the way now to multi-factor investing. So I think there's been some very strong growth. We don't think it's a fad. We actually think that smart beta strategies are actually very useful investment tools that both institutional and individual investors can use to help manage their portfolios.
Okay, the evolution from single-factor smart beta to multi-factor smart beta, can you tell us a bit about the difference and why that has happened?
Certainly. I think, in the early days of smart beta, it was all about using alternative forms of weighting different than the traditional cap weighting indexes. And so these strategies made sense for people who wanted to achieve a different sort of weighting model in the broad market. But it was also recognized that when you started to move away from the broad market, you would start to introduce factor exposures. So we definitely then saw a lot of investors wanting to try to manage individual factor exposures. So that created the popularity in single factors. And now we actually have strategies where investors are trying to actually combine multiple factors and achieve diversification benefits. So even though we know that individual factors over the long term might have risk premia, they might actually have excess returns over a benchmark, those returns can actually be highly variable or volatile over time. So actually it's combining those factors that allows investors to achieve diversification and hopefully smooth out some of that performance over time.
And one interesting development that we've seen is how there has been a growing interest in the use of smart beta strategies, particularly for ESG investing. What are the trends that you've seen around that?
Yeah, it's interesting. We actually asked a question in our most recent smart beta survey about how much institutional investors were thinking about ESG along with smart beta factors.
Yes.
And actually a large percentage said they were thinking of those in much the same way. So what's interesting is the technology has definitely improved. So traditionally, most investors would have implemented ESG through what we call negative screening. So they would start with a broad market index, and then they would remove stocks that didn't meet some sort of criteria. So it's this concept of negative screening. One of the things that happens, though, is you lose diversification. As you start to remove large groups of companies from a broad, diversified portfolio, you can start to find that you lose diversification. So we've actually now upgraded or evolved our technology, what we call now smart sustainability.
Smart sustainability.
Right, where we can actually look at ESG and implement that in a very similar way as we would a factor. So if we can score a company or a set of companies along some dimension, so carbon's a great example. So if we can assign companies some sort of a carbon score, some companies might have higher scores, some companies might have lower scores, we can then use our factor tilting function to actually tilt a portfolio towards lower carbon companies if that's what an investor wants. So similarly, we could do that with any sort of ESG score where you're able to basically rank companies on some score. We can use a tilting mechanism just like we do for factors with the ESG type scores.
And how would smart sustainability, as we call it, how would that be different from the traditional ESG strategies?
Again, so smart sustainability is we're no longer completely removing entire groups of companies. So as opposed to completely excluding a group of companies, we can now underweight or overweight those sorts of things. So an example would be for more environmentally sensitive portfolios in the past, we might have removed a lot of energy companies from a portfolio. Now with the smart sustainability, we can actually overweight companies, energy companies that might have some amount of improvement on carbon footprint, and we can underweight companies that maybe we don't want in the portfolio. But we're no longer completely removing those companies from the portfolio. We can now underweight and overweight according to how much we can see improvement in their carbon scores.
One other trend that we've seen is growing interest in the use of smart beta for fixed income investing. We know that, especially here in Asia, most smart beta strategies are focused on the equity asset class. But for fixed income, how do you see that sorting itself out?
I think it's true around the world that there hasn't been as much interest or clearly there haven't been as many product providers in the fixed income space. Again, in our global asset owner survey, over 2/3 of the respondents basically indicated that they really weren't considering smart beta in fixed income. There was actually a very, very small percentage that actually were doing that. But we think that's an opportunity. So we think that because there aren't as many product providers, there's less information, there's less education. And most investors really need to have information that allows them to make an informed decision. So we think that this is an area for growth. So even though it's relatively a small area right now, we do think that as providers like FTSE Russell start to bring products to market, we can increase the investor's comfort level by providing them more education and more information on these types of products.
One more thing about the use of smart beta for fixed income investing. You said that FTSE Russell has done some work on this aspect, right? Specifically, what has FTSE Russell done specifically to develop smart beta for fixed income investing?
Yeah, it's interesting because we just recently acquired the Citigroup family of indexes, and so in partnership with research affiliates, we actually have a set of multi-country indexes where we actually don't weight based on the total debt outstanding. We would weight based on GDP or potentially other measures of economic output. I think also, we know that within the Citigroup organization, we worked with specific clients.
Yes.
So while we might not have products that are on the shelf right now and available for all investors, as we've worked with specific investors, we've actually developed some unique smart beta strategies for fixed income.
Is smart beta a strategy that's here to stay, or it will die and people will go back to passive investing and active investing, and we no longer need smart beta for as a hybrid model in between?
Yeah, I think it's really here to stay, and I think one of the reasons is, smart beta isn't just about enhancing returns. So as you mentioned, as we potentially go into a very different return environment than we maybe have had over 20 years, you still have institutions and other investors that want to manage risk, or they want to improve diversification. So I think there's actually a wide number of investment outcomes that investors are looking at where that smart beta can help play a part. So even if you have maybe a different expected return outlook, I think there's still a lot of room for smart beta strategies to increasingly meet other investment outcomes. Now, I think also what we've shown as an index provider is that to the extent we can take strategies that once you had to pay active management for, and we can actually do those more systematically, we can be much more transparent about how those are done. I think there will always be demand for more transparent strategies, for more predictable strategies, which is what smart beta really represents. I still think there's a role for active management. There's going to be areas that I don't think indexes can achieve completely.
Yes.
But I think that smart beta is definitely here to stay.